Hello and welcome back to Principles of Accounting 1. I am still your host, Dr. B. Happy to have all of you with us as we are in the middle of the spring 2023 semester together. We have made it to week 8. In week 8, we will have a brief discussion on cash, fraud, and controls. And then we will talk about the midterm exam. So having said that, let's talk about this concept called cash, fraud, and controls, and then we will jump into a presentation on the midterm exam. To accompany this chapter, there's a discussion board for your homework assignment. What I would like you to do is to have an initial post response to the discussion board by Thursday, and then respond to 2 of your classmates by Sunday. Also due Sunday will be the midterm exam, but we'll talk about that part here in a second. So as we talk about cash, fraud, and control, I want you to think about how cash works. We use cash to purchase goods and services, to pay our bills. We also receive cash from our customers when they purchase our products or they pay their accounts receivable. Anytime that we use cash, there's always that possibility that something might happen to it. It might go missing. We might get paid too much or paid too little. Call that over or under. For those of you who have ever worked in retail, I know that you know what I'm talking about. You have a cash drawer. That cash drawer needs to be exact. Reconcile the cash drawer at the end of each shift. And if it's not exact, that means it's over or it's under. If your cash drawer is over or under, that usually means management going to say something to you. And I've been there, done that. That was a part of my retail career. And sometimes I would have a little too much cash in my drawer, which means I didn't give enough change, or not enough, which means I gave too much change. Yeah, so it happens. But it's important that we understand cash, how it works, how to control cash and our other assets, and how also to identify fraud when fraud happens. So these are the things we're going to talk about today. Let's go ahead and jump into it. So, it is very important that we as accountants, we as managers, and we as business owners protect our assets. We need to control our cash. We need to control our inventory. We need to control our property, plant, and equipment. We need to protect those things. We need to control those things. And to do that, we set up policies and procedures called an internal control system. An internal control system helps us to protect our assets. This system also ensures that our accounting is reliable. What I mean by that is, when I do my inventory count, it matches what I have in my inventory system. When I count my cash in the bank, it matches what I have in my accounting system. When I track my property, plant, and equipment, it matches the value in my accounting system. That's what it means to make sure that our accounting is reliable. Our internal control system helps us to uphold our company policies. This would include things like human resources policies, internal processes and procedures, etc. And an internal control system also helps us to promote efficient operations. How well am I using my resources, my assets? An internal control system helps me to establish and promote the efficiency when it comes to using our assets. Back in 2002, two senators in the United States Congress got together. Sarbanes-Oxley, or the two different senators. They created what's called the Sarbanes-Oxley Act. This act requires managers and auditors of public companies to document and certify the system of internal controls. Simply put, this means that every publicly traded company is required to document, provide that documentation to investors and to other external stakeholders to validate that they have a process in place. The system of internal controls really helps to prevent fraud from happening. Controlling your assets, you're able to effectively help prevent fraud from occurring. Now, the reality is, fraud finds a way in to every business, unfortunately. Most of the time it's unintentional. Sometimes it's intentional. Fraud is the act of stealing, basically, or deceiving investors, or deceiving employees, or deceiving management, etc. That's fraud. Fraud is deception, in essence. And it usually involves a monetary gain. And to prevent that, Sarbanes-Oxley Act was developed to help prevent fraud from happening to investors. It requires transparency in the operations of the business, which includes internal controls. That's the basics of it. There's an organization called the Committee of Sponsoring Organizations. And this organization it's a nonprofit organization that helped to develop the elements of internal controls. And these elements of internal controls help to add quality to accounting information systems. And here are the 5 elements: control, risk assessment, control activities, information and communication, and monitoring. Control environment, that first element, has to do with controlling physical property, plant, and equipment, and other assets. You hear the word environment, it means the natural environment of the business. That's the physical components, the property, plant, and equipment, and other physical assets. This also includes human resources, the people. To control the environment, I'll give you an example. Think of a gas station. Okay, a gas station, there's a lot of risk there, right? You got your gas pumps, you got your convenience store, and you got employees and customers. That's the environment. It's the physical environment. It's the gas station itself. So we want to control that environment. How do we control a gas station environment? We have the flame system, the sprinkler system, in case a fire starts. That's a way of controlling and protecting the assets, right? We have security cameras. Helps to control the environment. We have a register system. We have a time clock system. We have an accounting system. We have an inventory system. All of these elements together are part of controlling the environment. The second item is called risk assessment. Risk assessment is where we, management, have to identify potential areas of risk and mitigate that risk from happening. A couple of examples. Let's look at our gas station, for example. There's a risk of fire. In order to mitigate that risk, I have a sprinkler system. There's a risk of theft. I have a security guard and alarms to help to mitigate that risk. There's a risk of slip and fall, where a customer slips and falls in the parking lot or inside the store. To help to mitigate that risk, I make sure I salt the sidewalks. Make sure it's clean, clear of debris. That's a part of risk assessment. Identify areas of potential risk and create a strategy to mitigate that risk. Number 3 is called control activities. Control activities are activities used to control business. A couple of examples. At the gas station, we have a way where we count the register drawers, the cash inside, using a process. We print out the tape from the register. We match it with the cash that's in the drawer. We take out the excess cash, put it into a deposit bag. That deposit bag with a slip into the safe in the back room. That's a control activity. Another example would be, I use a sheet of paper with all of the items that my store sells. And next to that, the items are the quantity that I should have on my shelves. I physically count each item and match that with the number of items I should have on the shelves. That's a control activity. The fourth item is information and communication. In business, it's extremely important we communicate information to our employees, customers, stockholders, the government, and any other stakeholders. Provide them with necessary information, things they need to know. And we do that on a timely basis. Examples of this would be, I provide my income statement, balance sheet, statement of cash flows, and statement of retained earnings to my investors at the end of every single month. My SEC filings. The fifth element is called monitoring. Monitoring is not just monitoring employee behavior, it's also monitoring the environment, monitoring the transactions, monitoring the elements of the business. That's the concept of monitoring. We're watching it very carefully. Those are the 5 elements of internal control systems. Principles of internal controls includes establishing responsibilities, maintaining adequate records, ensuring assets and bond key employees, separate record keeping from custody of assets, dividing responsibility for related transactions, and applying technological controls, just naming a few. So let's go through these relatively quickly. Establishing responsibilities. These are the job descriptions. Okay, some employees are responsible for being a cashier. That involves handling cash and ringing customers out and managing the cash in the cash register. That's a cashier's general responsibilities. Responsibilities for a manager might include the oversight of the operation. It would include things like hiring employees, training them, monitoring their progress, monitoring the overall business operations, promoting sales, handling the day-to-day operations, etc. Those are the responsibilities of the management. I could go on and on, but the concept of establishing responsibilities is job descriptions for employees. It's a great way to think about it. Number 2 is maintaining adequate records. This involves making sure that your accounting transactions are accurate, making sure that you keep track of all of your packing slips, invoices, copies of checks, etc. That's what maintaining accurate records means. Number 3 is ensure assets and key employees, bond key employees. This one's a little bit more complex, so I'm going to walk this through with you. Ensure assets. Make sure you have insurance for your assets. You personally, that means having renter's insurance, homeowner's insurance, car insurance, life insurance, etc. For your business, that means having liability insurance, general liability insurance, an umbrella policy, etc. We're talking about insurances. Insure your assets. Protect them. Yep. And the second part of that is bond key employees. Here's what we mean by this. To be bonded, it means to be in a legal agreement with the company. If you hold the keys to the business, the physical keys, to lock and unlock the door, or the register, or whatever, you're a key employee. That's where the term came from. You hold the keys in your pocket, therefore you're a key employee. Very simple process. The bonding part is where you sign documents to be bonded. Basically, the business is insuring you, and you're insured by the business. In other words, if you, a key-holding employee, do something silly, like lose money somehow, some way, business is insured. That's what bond key employees means. Number 4 is separate record keeping from custody of assets. I'm going to explain this one through an example I had when I was working at the hotel. I was working at the hotel as a controller, assistant controller. One of my responsibilities was to go behind the front desk, take all of the cash into the safe room, and count all the cash. I didn't do that by myself. That would be silly. That's a lot of cash. You don't want one person counting cash. You want two. Why two? One to count the cash, and the other person to record the transactions of the cash. The two must always be separate. The reason why is because if they were together, that creates an opportunity for fraud. If I'm a person who's both writing checks to pay the company's bills, and I'm also the same person receiving the bills, it could be a problem. Because I could misplace a bill. and still put the bill into the computer system and make it payable to myself. It's fraud. Yeah, and it's illegal, but it's also fraud. It's important to keep separate record keeping from the custody of the cash. Make sure those two are separated. Number 5, divide responsibility for related transactions. That goes back to my paying the bill transaction. In the hotel business that I worked for, we had more than one person paying bills. We also had more than one person receiving payment from customers. We also had separate people for payroll. The reason why we had all of these separated responsibilities for the related transactions is to ensure that there won't be any fraud. If I have one person over here collecting payment from customers, another person over here paying bills, and another person over here responsible for payroll, what I'm doing is I'm dividing the responsibilities for related transactions. See? Just to prevent fraud. And the last one here is applying technological controls. This would imply using things like security cameras, cash registers that record transactions, barcode readers, etc. Those are all technological elements. When we establish responsibilities, it's important that everything is very clear and documented. All the tasks should be very clear and documented in the job description. Tasks should be assigned to one person. That way we can determine who's at fault if something goes wrong. We maintain adequate controls, helps us protect the assets, monitor activities. It also includes detailed records, chart of accounts, pre-printed forms, etc. These things help us to maintain adequate records. It's like I told you earlier. I keep copies of all the checks, packing slips, invoices, bills that the company received. I keep all of those things, and I keep them all separated. But I keep all like transactions together. So the way that I used to do it is first, if I received product from a vendor, I take the packing slip and the invoice together. Okay, and then I put the invoice into the accounting system, and I print the check. Now I have the packing slip, the invoice, and the check. Those 3 documents to trace the transaction. I'll probably also have the purchase order there too. So purchase order, packing slip, invoice, and the check. Those 4 documents are all related to one transaction. Okay. I'll staple all 4 of those things together. Take it to the controller. The controller will sign the check. Then I'll take it to the general manager. General manager will review, sign the check as well. That's how you maintain adequate records. The reason why it's important is if you ever get audited by the IRS, you want to make sure that your documents are in order. When we insure assets and bond key employees, just as I was saying earlier, assets should be insured. Employees handling the cash should be bonded. This, of course, means that the company purchased insurance policy against theft by bonding that employee. Separate record keeping from custody of assets. You want to have separate people, okay? One person taking care of accounts payable, one person taking care of accounts receivable, one person taking care of payroll. Okay, what that does is it helps to keep things separated. One person who controls has access to all the assets, must not have access to the asset accounting records. Keep them separated. The person counting the cash should not be the same person making the bank deposit. Keep them separated. Reduces the risk of theft. Divide the responsibility for related transactions. And keep them separated. That's the theme of today's story, right? Responsibility for the transaction should be divided between two or more individuals. Here's that one person acts as a check and balance to prevent fraud or errors. And technology, electronic records, receipts, time clocks, scanners, security tags, you name it, right? All of these are technological controls to help to control the assets. Oh, and not to mention, real important that we perform regular audits, independent reviews. We call them audits. It's important to audit your own company. Why? Because it helps to ensure that we follow the procedures, that everything was done correctly. It helps us to evaluate the efficiency and effectiveness of our internal control system. That's why having our company audited once a year by an external auditor also helps to ensure this. But it's also good to have once a year your company audited internally. The internal control process helps us to reduce the processing errors. It provides new evidence of processing, more extensive and testing records, separation of duties, and increased efficiency. Very, very important. That's why I always say that gotta cross your T's and dot your I's. So important that you double check your work, especially before you submit it, like an exam, for example. Just be very, very careful. Yep. A couple of limitations, of course. Human error. People aren't perfect. We all make mistakes. I make plenty of mistakes. Promise you I do. Sometimes people could be a little careless. I should have double checked my work. I didn't. I accidentally clicked the submit button. It happens. It's okay. It's okay. You misjudge something, get a little confused. Sure, it happens. We're all human. We all make mistakes. Sometimes humans might still find a way to game the system for personal gain. Yeah, unfortunately, human fraud still happens. Why does human fraud happen? There's an opportunity for it to happen. There's financial pressure that the person might be under. And then there's that realization, rationalization, thinking that it's okay to do something. A couple of definitions to be aware of and to really understand. When we talk about the control of cash, we're talking about a system of internal controls that protects the cash and cash equivalents. When cash separated from the record keeping, like we talked about earlier. Cash receipts are promptly deposited into the bank. Don't wait till the next day. A lot of times, if you've ever worked in retail, like me, for example, what we used to do, those two things, really. If you can't get to the bank at night to deposit the cash, you have a safety deposit box in the back room. But really, you should be trying to deposit that cash to the bank immediately, as soon as possible. Okay? So at 9 o'clock at night, when you lock the doors for the night, to the store at the mall. You go in the back, you count the cash registers, put the excess cash into the deposit bag with the receipt, document everything. You seal the bag. I think you drive it over to the bank, walk it over to the bank, and put it into the deposit box. Very, very important to do that the same night. If you can't do it the same night, make sure it's somewhere safe. It's also important to understand cash disbursements. Sometimes in business, we have what's called a petty cash fund. Petty cash fund is used when there's a small transaction you need to do quickly. For example, at the hotel, the front desk at the hotel, you may have a guest that shows up in a taxi cab and doesn't have the cash to pay the cab. The hotel will do that for the guest. Just pay the cab. Obviously you get a receipt, put that receipt inside the petty cash fund. That's what's called a cash disbursement. Cash went out, a receipt went in. So at the end of the month, bring all your receipts to the accounting office, and they replenish the petty cash fund based off the receipts. I mentioned the word cash and cash equivalents. Cash is cash. Paper, money, coins, checks, certified checks, money orders. That's all cash. Yeah, it's all cash. Cash equivalents. This is short-term investments. Short-term investments can be quickly converted into cash. Stocks and bonds. Those are short-term investments. I can quickly sell my stocks and bonds and convert those into cash. Call those cash equivalents, stocks and bonds. Sometimes short-term loans, it depends. It's so important that we manage our cash effectively. We got to make sure we have enough cash in the bank to pay our bills. If we don't have enough cash, we can't keep running the business. So we need a minimum level of cash necessary to operate the business. Okay. It's also very important for you business owners out there. If you ever get employees, you need to have a separate bank account for payroll. You need to maintain a certain amount of money in that account in order to meet payroll. It's a legal requirement. Effective cash management involves things like encouraging the collection of receivables. We talked about accounts receivable a lot. I might have a customer that didn't pay me in 30 days. Then I send them a past due notice. Then 60 days. Send them another past due notice. 90 days. Send them another past due notice. 120 days. Oh, now we're getting crazy. Please make sure that you encourage your customers to pay you. And pay you on time. So encourage the collection of receivables to get your cash in, yeah? Late payment of liabilities. A long time ago, when I was broke, I used to have 3 piles on my desk. One was called Pay Now. The second pile was called Delay Now. And the third pile was called Throw Away Now. Pay now, delay now, throw away now. Those were my broke days, long time ago. I'm not as broke these days. Still broke, but not as broke. So, what I mean by that is, if the bill is due in 30 days, pay it on the 30th day. Paying it early, sometimes, yeah, it might help you if if you're paying it on credit terms. We talked about those, the 210 net 30, 2% discount, pay within 10 days. Otherwise, the whole thing's due in 30 days. I'll pay early if there's an incentive, but I'm not going to if there's not. So that electric bill, guess what? Paying it on the last day it's due. That's calling the delayed payment of liabilities. Keep only necessary assets. If your company's cash strapped, you don't want to have extra parts laying around, or extra machinery or equipment, or extra anything. Just keep the necessary stuff to run the business. Go crazy buying all this inventory, knowing that you're not going to sell it for another year. Don't do that. Of course, plan for expenditures. If I know something's going to break in the future, I want to make sure I have enough cash to pay for it later. Apply internal controls to your cash receipts and payments. It's so important to manage your cash. Managing cash flow is a big part of the business. Look at this photo here. Cashier rings up cash sales in the register, prepares a cash count sheet, and sends to the company's cashier along with the cash. Cashier is really another word for the cash office. Yeah. The sales department receives the cash sheet documents and sends their cash to the cashier's department or the cash department. They record those cash sheets in the accounting system. You see the process. This is how we control cash when we receive it from our customers. The counter. Oh, sometimes be so careful. Okay, be careful. If you're a cashier, oh my goodness, be careful. Don't give away too much cash. Okay. Give the proper amount. Sometimes we make errors. I gave a customer too much change, or I didn't give him enough change. I know. It's silly, but it happens. Let's take a look. Cash register record shows $550. We counted the cash and it shows $555. Whoops, I forgot to give $75 change. I have to record an adjusting journal entry. Here's how it looks. I debit cash $555 because that's the cash I have on hand. I credit an account called cash over and short, $5. Okay. When you credit this account, you're identifying that you are over. If you debit this account, that means you were under. Then we credit sales, $550, because that's what we sold. Make sense? Awesome. Okay, that's what I like to hear. Here's another example. Now we're under. Cash register shows $625 in sales. Counted the cash and only shows $621. Man, I might get fired. It's $4. Make an adjusting entry. Debit cash, $621. Debit cash over and short, because I'm short, $4. And I credit sales, $625. Okay, I'm going to say this once. Never put physical cash in the mail. Please, never put physical cash in the mail. Don't do that. It's risky. Don't do it. Don't put physical cash in the mail. Please don't do that. Something will happen. The mailman will notice. Okay. All right. Sometimes people put cash in the mail. Don't do that. Yeah, don't do that. That's smart. Few people are assigned to the opening the mail. Cash deposits go into the bank. The keeper records the amounts received. Separation of duties. Control your cash payments. Make sure all payments are made by check. Check, not cash. Check. A lot of times you'll even see, like your Pepco bill, it says, don't mail cash. Send a check. Yeah, don't mail cash. Limit access to cash except for those who have the authority to sign checks. Establish a cash budget. You gotta have a budget. The voucher system. This part has to deal with your discussion board that's due on Sunday. Your original response due Thursday. This is the voucher system. The voucher system establishes procedures for verifying, approving, and recording liabilities for eventual cash payments, and issuing checks for cash payment of verified, approved, and recorded liabilities. I want you to do a little bit more research, okay, on voucher system controls. For your discussion board. Here's how it looks. Here's a nice visual of it. You can see all of the paperwork involved in transactions. Your purchase requisition, a purchase order, invoice, receiving report, also known as a packing slip. Invoice approval, we write the check. All 6 those documents for one transaction. It's a lot. Absolutely it is. That's a good system of internal controls right there. All of those papers individually, we call it a voucher system. All of those papers together, called a voucher system. Think about my example I gave you from the hotel. Got a purchase order. We sent out the purchase order to the vendor. They sent us the stuff that we ordered with a packing slip in the box. Matched the purchase order with the packing slip. Then I got the invoice, the bill. Processed the invoice. I printed the check and then gave the check along with all those papers, paper clipped together, to the controller. Controller signed the check. And then the manager signed the check. And we sent the check off. See? That's a voucher system of control. Petty cash. I talked about this briefly earlier. We use petty cash for small payments. It's cash at the front desk that we use for small payments like shipping fees, minor repairs, low-cost supplies. We used to have a nice person come into the hotel lobby every week with fresh flowers and would also clean the fake flowers. You know, we would pay in cash. Yeah, it's very small transaction. And the person would provide us with a receipt. The receipt goes in the petty cash drawer. We then give those receipts to the accounting department. The accounting department would replenish the petty cash fund. And to do that, they would create a journal entry debiting petty cash and credit cash. To establish the petty cash fund in the first place, debit petty cash and credit cash, they're both technically cash accounts. They're both asset accounts. Petty cash, credit cash to establish the petty cash fund. As time goes on, I'm using the petty cash fund to pay for small things. I receive receipts in exchange for those small things. I add them all up on what's called a petty cash payments report. At the end of that month, I refund reimburse the petty cash fund by debiting all of those expenses and crediting cash. See? That's the petty cash fund. That's how that works. Simple. Very straightforward. To increase the petty cash fund, debit petty cash, credit cash. To decrease it, debit cash, credit petty cash fund. Very straightforward. It's basically like moving cash from one bank account to another. Same process. Over under, we generate a report when there's an over under. This is when your cash drawer is short. If it's short, we debit the If your cash drawer is short, we debit cash over in short. If it's over, we credit it. I mentioned that earlier. This is just a nice visual representation of it. And just a quick note on what banks offer. A lot of different things. Deposit tickets, service, signature cards, bank accounts, checks, electronic fund transfers, bank statements. This is just a short list. They offer a lot more than this. Just the basics. What a deposit ticket looks like. We use this deposit ticket when we deposit all that cash I was talking about earlier. So we take our cash that we're over, right? All the excess cash from our cash register. We put it into a deposit bag. And inside that deposit bag, we put what's called a deposit ticket. The ticket shows any checks and cash together. Yep. It's a document that serves as proof of the deposit. Hopefully you've all seen a check. I mean, I'm sure some of the younger folks in the class, maybe you haven't seen a paper check. If you haven't, this is what it looks like. Here's an example of it anyway. The maker who's paying the check, payee who the check's being paid to, the dollar amount, and written out dollar amount. Some of you probably don't know how to do cursive anymore, but cursive is, another form of writing. A memo, what it was for. Yeah, it's real important to know what it was for. And then, of course, the signature. And sometimes at the bottom there might be what we call a remittance. It's basically like a copy. Yeah. Bank statement. We use this at the end of every month to reconcile our bank account. Make sure that the cash that we have in our bank account matches what we have in our accounting records. Shows all of the cash that came in and out of the account, check numbers, etc. And service charges, bank fees, non-sufficient fund charges, etc. All those fun bank charges that we managed to see. Yeah. So I was just mentioning about the bank reconciliation. So we use that bank statement and we reconcile. I usually do this at the end of every month. I reconcile what I have in the bank account to what I have in my accounting records, my QuickBooks. And what this does is it helps me to verify that the money that I have in the bank matches what I have in my accounting record. And if there's a difference, I need to adjust for those differences. So adding deposits in transit, subtracting outstanding checks, making any types of corrections, etc. Why do we do bank reconciliations? Yeah, we want to make sure that our accounts are accurate. This is just a real quick formula to help you to identify the adjustments that you need to make. Yeah. Cash balance from the bank statement, plus any deposits, minus any outstanding checks, plus or minus any bank errors or fees, equals the adjusted cash balance. We do the same thing for the books, for your accounting records. Cash balance from the accounting records plus collections and interest minus any bank fees or insufficient funds, hopefully not, plus or minus any errors, hopefully not, equals the adjusted cash balance. And this kind of just shows you visually the steps that we take to go through to reconcile the bank statement. And at the end of the day, we want to make sure that our adjusted bank balance matches our adjusted book balance. Here are the adjusting entries that we would make based off of adjustments we need to make from the bank. Collection of notes, interest we may have collected from our balance of cash, check printing expenses, non-sufficient funds expenses, etc. One of the last things I want you to know, and I think we've talked about this one before, it's days sales uncollected ratio. We talked about days sales uncollected before from when it comes to how many days it takes us to collect payment from our customers. This is the ratio of days sales uncollected. We take our accounts receivable balance divided by our net sales. Accounts receivable balance, of course, comes from the balance sheet. Net sales comes from your income statement. We multiply that by 365 days. It gives us number of days it takes to collect our sales from our customers. Yeah. We use documentation to verify our and control our cash, as we had talked about earlier. We take the purchase requisition, purchase order, invoice, receiving report, and then ultimately the check. Altogether, we use these documents to verify the receipt of the goods and ultimately the payment of the goods in the purchase. There's an invoice approval process that most companies utilize. It goes through a process of approving payment after all the documents are in order. I gave you the example from the hotel where I would take the invoice, the packing slip, the purchase order, the check all together. And I'll paperclip them with a check on top, bring them to the controller's office. The controller will then flip through to make sure that the transaction actually happened for the invoice approval process before we pay it. Yep. The voucher, again, another important slide to know for your discussion. Voucher is complete after invoice has been checked and approved. Used to authorize the recording obligation. Information is required inside of a voucher and contains information required outside of the voucher. So, again, do a little bit more research on voucher payment systems before you write your initial discussion post. And talking about that real quick, I want to bring you back to the classroom for the Chapter 8 discussion board. Thank you so much for those of you who already started the discussion process. I really do appreciate that. I see a lot of awesome posts here, very well detailed. I see some research here using the textbook. Great. You can also use outside resources if you like. Whatever you find easiest. I also made my own post a couple hours ago just to kind of help you to better understand about your system. Your post doesn't need to be as long as mine, but hopefully what I had written helps you to write yours. And I see a really good discussion going on here, and I see wonderful responses, nice full paragraph responses. That's what I love to see. So please, if you wouldn't mind, make sure that your original post, your response to the discussion topic, make sure that that's done by Thursday night. And please make sure you respond to 2 of your classmates by Sunday night. That'll help you to get full credit for the discussion, yeah? Any comments, questions, or concerns about cash, internal controls, any of that kind of stuff before we talk about the midterm exam? All good. Sure. We do okay. All right. Okay. Okay. I'm going to stop this part of the recording, and then I'm going to start a new recording, okay, for the midterm exam overview. So hold on just a sec. Bear with me. Hold on now. Don't go nowhere. We're going to talk about the midterm exam.